Right, good evening everyone, and thank you for coming to hear the story of PCF Bank this evening. We released our preliminary results last Wednesday, so great timing to come and share with you the progress of the company and our strategy for the next few years. So I've got about 16 pages here to go through. I'll go through fairly quickly to leave you plenty of time to ask any questions at the end, and also the presentation's available as a takeaway as well if you'd like it in an A5 size. Just dwell on this for a minute because we are a little unique as a listed bank. There's not many banks on AIM, one other I believe, and we're one of the new breed of banks. We got our banking licence back at the end of 16, and we actually started taking deposits in 17. So we've really only been a bank for a little over 2 years. Banking licences aren't given out cheaply. They're hard earned, and we've put it to good use. So it makes us a little unusual on the AIM market, and it gives us an opportunity to operate in some very large markets, taking on the high street banks who I'm sure you've all heard really are underserving both consumer and SME businesses. We lend into 4 areas. We're a specialist bank, so we don't offer what you might consider the normal banking products, current accounts, Visa cards, etc., etc. We specialise in areas that make the returns that we require as an organisation. So the largest part of our book is business asset finance, the second one down there, and the consumer motor book is the second largest part. They're really the traditional parts of the business. They're the parts of the business we operated in before we actually became a bank. Since we've become a bank, we've diversified our business lines, and last year we made an acquisition of a company called Azul Limited, which specialises in broadcast and media equipment, so cameras, lenses, post-production equipment, sound and lighting. It has the direct relationships with Sony, Canon, Midwich across the UK and Europe. And we've organically set up a bridging property finance team by taking some individuals from inside a competitor, and they started their operations in January this year. The portfolio's got to 339 million. We set targets 2 years ago when we became a bank in July 17 of a medium-term target of 350 million by September 2020 and a 12.5% ROE. And I guess the great news in these results is we're almost at that portfolio target, and we've exceeded the 12.5% ROE a year ahead of our original plan. We support that with retail savings, 267 million portfolio. And in box 3, I guess the main point to pull out there is our strategy to move into the prime sector. As a finance company, we lent to the near prime sector, cheaper cost of funds from banking. We've moved into the prime sector, and our success has really come from penetrating a part of the market we were previously excluded from on price in products that we've known and operated in for a lot of years. So it was a fairly low-risk way to scale the business post-banking licence. We raised equity in March, and we have supplemented that this year with a Tier 2 facility, which can be drawn down as required to support growth. And there are some of the KPIs there on the right-hand side. Net interest margin of 7.8, return on equity of 12.6, return on assets, impairment charge, and cost to income ratio, all of which I think are pretty superior for a 2-year-old bank, and certainly numbers that we're quite proud of so early in our growth cycle. Just a couple of operational highlights from the results last week. We've spoken about the portfolio in the middle of 339. That was an increase of 55%. We got there with originations of 276 million of new business, up 86%. Big increase. 30% of that new business volume, however, came from our 2 diversifications, the acquisition and the new property finance division. So they've performed very strongly. Deposits I've already spoken about. I guess the other bullet points to really pull out there is impairment charge of 0.8, up slightly on the previous year, but it does include an adoption of IFRS 9 for the first time, which did take 300,000 of profits off our bottom line, taking that new standard into account. Financial highlights. PBT, £8 million, up 54%. Operating income up 51% to 22 million. Net interest margin is pretty steady at 7.8. We're managing the quality of the book, I've already mentioned, into the prime space, so we expect that to fall. Our long-term target is to keep it above 7%. We do expect that to slowly trend down as we replace our old receivables with slightly lower yielding receivables, but of course they're offset with a lower impairment charge and a lower cost to income ratio as you get the operational gearing from building the portfolio. Earnings per share up 35% at 2.7p. Cost to income ratio is stable, came down a little bit, but I think 50% is a superior cost to income. To consider we've only put the infrastructure and the costs of the bank in place 2 years ago, to already be at 56% isn't too shabby and ahead of some of our competitors already. Return on assets at 2.9, easy one for the audience to measure our likely future profitability when you see our portfolio targets. And I've already spoken about ROE, and our capital ratio as required by the Bank of England is comfortably ahead of the minimum that would be required for a bank of our size. Quickly run through the business lines. There's the new business growth. You can see how strong it's actually been. The bottom two, 25% of the volume came from Azul, 5% from the bridging, so 30% from the new areas, and 74% of everything we wrote right across the business is in our prime credit grades. So very pleased with the field effort to increase originations. Our traditional business finance side, SME lending to the private sector in the UK, we have a tiny market share, less than 0.5%, and that's why we've been able to succeed. We're effectively succeeding in a very large market with a very small market share, going fairly unnoticed by the competitors. So we can continue to grow that portfolio strongly. Average deal size of £45,000 gives us a good spread of risk. 71% was in the prime credit grades, and the portfolio's got to almost 180 million by the end of the year. This part of our business and the consumer side of our business, our route to market is broker intermediaries. So we were able really quite quickly to put the cheaper funds to work by just speaking to those brokers and asking them for that prime business that they previously didn't send us because we weren't prepared to write that business at the lower yield because of our previously higher funding cost. Consumer motor, once again broker driven. This is hire purchase for used vehicles. You will have read about the motor industry, lower new car sales, etc. We've always been in used. We don't want to take on the manufacturer-owned finance companies. We also like the fact that they've taken their depreciation hits, so we do nearly new or used vehicles. And if you read the results of the dealer groups, you'll see that used vehicle sales have actually held up pretty well over the last 2 years. It's the new market that's been difficult. And not being in new as well means that we don't have to offer the products like PCPs, which take the residual risk on your own balance sheet. So it's a great area for us. And the area where we've had some real success this year, we have a small specialisation in leisure vehicles as well, horse boxes, classic cars and motorhomes. It's only a small part of the business, but it's pretty underserved, and we've been able to take Lloyd's Black Horse on head on with our new cheaper rates and win part of that market share. Azul, I've already talked about it being in broadcast and media. It's a different route to market for us because it's direct to the manufacturer. I've spoken about the other parts of our business being through broker intermediaries, so we're diversifying the business as far as the way we take on our business as well. They have a hybrid model, which is great as well. So because they have to place all the Sony and Canon and Midwich business around the UK and Europe, we mightn't like the credit risk of some of that, Some of it might be such blue chip companies that we're not prepared to offer such a fine rate. We broker that on and place it with other banks who want that for a fee. So we're now earning fee income off a lot of that origination, placing the other business on our own balance sheet. And sometimes we also place that business if we've allocated a credit limit to a customer. They've come back for another transaction and we say, no, let's just sit on our credit exposure for a little while. We'll place that business on as well. Similar deal size to our business finance division, and in most respects this is business asset finance. We're only reporting on it separately here because it is a new acquisition. We want to tell people about how successful it's been, but it will fold into our business finance division. The products are similar, lease and hire purchase. Bridging property finance, this is first charge lending against residential and commercial property for either acquisition of the property at auction, refurbishment of the property, or developer exit from the property. I would stress it's true bridging. It's not development finance. The property can't be undergoing any structural work, so it's got a roof, it's got windows, it's watertight. Yeah. And you can see there that the average LTV on the portfolio is 59%. Average term is 12 months, so it's shorter term lending, which fits very nicely with the rest of our portfolio. I think I've been through the achievements already. We've grown our core businesses extremely strongly. We've also, recognising that they will become mature in times in years to come, we've diversified the balance sheet with a couple of new asset classes, showing our skills at both acquisition and organically starting new businesses up. We've improved the proposition for our consumer motor, and I'll come on to that shortly, and we've also done capital planning for the future by raising capital and putting in place a Tier 2 facility. All the time investing in the systems and infrastructure that a bank needs to drive you forward to a much bigger portfolio. So what will our future operating model look like? We've had a lot of success in business finance moving prime. It was fairly easy because a lot of it's manual. You're assessing balance sheets, profit and loss, cash flows, you're talking to the principals of the business, you're understanding the business model. In consumer motor, it's very automated. Consumers these days expect point of sale motor finance. Go in the dealership, sign up the finance, drive away the car, and it's got that slick. We weren't really set up for that because we were in the near prime market. So we've spent most of this year updating our systems, putting automation in place. In the first quarter of next year, we'll be launching for the first time a proposition to the marketplace which is true prime motor finance. So that side of our business should see really good growth through 2020. We'll also, the third one down, we'll circle back and update our business finance portal, which hasn't had much TLC for the last 10 years. And now that we're finished with consumer finance, we'll look at automation's come a long way. So we'll build all the APIs and the links into a lot of business services that will give us a certain amount of automation in business finance. It's always going to have a little bit of a manual effort behind it. And we'll look at the Azul capability. As I said, Azul can go right across Europe. We don't feel as though it's a time to be taking credit risk, European credit risk on our own balance sheet, but maybe there'll be some clarity through 2020, and what we will at least look at doing in the meantime is placing that European business with European banks, and we want to increase that panel of European banks. A lot of people say to me, this slide's there because a lot of people say, why is PCF Bank having a good time of it when I hear financials aren't having a great time of it? And the truth is, it's where we are in our growth cycle. We're only 2 years into being a bank. We have very small market share. We've grown, we've used the funds wisely, we've used the capital wisely to grow the portfolio relatively quickly, but sensibly within the sort of credit model that we've always operated the business. So we haven't had to take a great amount of risk. And that will remain for quite some time, and we can continue to operate that way. And the top point there is that the hard work we've done in the last couple of years leaves quite a bit of income on our balance sheet to run off over the next couple of years. So there's certainty of earnings in our model as well as the business continues to operate. So down the bottom there you have the small market share, the diversified income streams, which reduces risk. Capital headroom is in place. We have access to the retail deposit market, which is an absolute pleasure, and we've got an infrastructure in place to build a much bigger business. So that gives us confidence in our model going forward. There's some consensus numbers on us in the years going forward. And I think if you're using this year as the base, 100 there, you can see how that multiplies up over the course of the years to a PBT of in excess of 20 million by 2022. So in summary, I've got 4 minutes to go, so I think that looks about right. We've entered this period with a record month in September, which is our last month of the last financial year. October's continued the same, so the momentum of the year ending September 19 has continued into the new financial year. In box 2, at the same time we set the 350 million target back in 2017, we also set a 750 million portfolio target. That's been in place for 2 years as well, and we set that for September 22. A lot of people say, well, you're a year ahead of your first target. What are you doing with your old one? Well, we do have ambitions and aspirations to get to £1 billion balance sheet. I'm sure we will, but until we see a little bit of clarity and certainty in 2020, I'm not yet removing the 750 target from the marketplace, and we'll leave it there, and I think over time you'll see the 1 billion turn from an aspiration into an actual firm target. If we were to get to £1 billion, our portfolio would look something like that in my vision. So asset finance will have a large part to play, that's including Azul. Motor finance is just about to take off next year with the new automation. Property finance will build a book of up to 150 million, and you will see us to continue to diversify with 2 new asset classes coming in over the course of the next few years. We'll continue to invest in the business. We're a year ahead of where we said we'd be. Now's the time to build infrastructure, get the people in place, have the right operating platform, and we'll continue to digitalise different parts of the business, as I've already mentioned. We're cautious in our risk appetite. We see no reason to change that. Of course, we have a small market share. We actually don't have to chase yields too much. We don't have to take more risk than we're comfortable with, and that's the model we've operated in for many a year. And in box 6 there, you've got our targets looking forward: return on assets at 2.75, return on equity of 15%, and our NIM target staying above 7%. So I think that summarises where we are. Hopefully that gives you some vision as to where we're headed as a business. We're happy to set those targets and be judged by them. We've had a great few years since we've become a bank, and actually even before that, the banking licence project in itself took 2.5 years. So in effect, we've delivered from the time we've said we've become a bank through to now, and I think there still remains a substantial opportunity in this business to continue to grow at a similar pace for the next few years, offering shareholders great value and great growth. So thank you.
Lovely. Scott, thank you very much. Thank you. Do you have any questions, please? Gentleman at the back here, please. Chris. Microphone there. Thank you.
Hello.
Hello.
Thank you for all you've done for the last 2 or 3 years for the shares. But your last slide was very interesting. Box 3 was particularly interesting because it really summarises what I'd like you to tell us a bit more about. What are the possibilities regarding the new asset classes? Where do you see your going easily? Where do you see it being difficult for you? You must be getting a sense of now you're a bank, now you get lots of cheap money, and now it must be tempting to lend to all and sundry. Where do you actually think you're going to be going, and who are the competition where you are trying to go? You must have an idea about what asset classes or what markets you're going to move into and what the impact will be on you of these other challengers.
Yeah. Do I have an idea? I have an idea that they'll be complementary to the markets we already operate in. So I think they'll be related to the consumer market or they'll be related to the business finance. Am I actually researching those asset classes at the moment? No, I'm not, because we've just made an acquisition. We've just started organically a new division. We've got plenty to work with. As you've seen, our core divisions are still growing very strongly. I think I can deliver over the next year or two our targets without that diversification. We will need that to get to $1 billion. We don't need it right now. For that reason, I'm not hanging my hat on any one particular asset class. It's almost easier for me to tell you what it won't be. It won't be residential mortgage, it won't be buy-to-let, and it won't be commercial mortgages. The banking sector makes a typical NIM of about 2.4%. You've seen what our NIM is. The building society sector make an appalling NIM of 1.7%. I don't know how you make money at that sort of level. Well, they're mutual, and I guess they don't. So we won't be operating in those spaces. But if you asked me this time last year or the year before, would I be making an acquisition of Azul? Would I be moving into broadcast and media equipment? I wouldn't have known at that point in time. And as box 5 said on that slide, I think there's going to be a lot of opportunities in our space. There's a lot of financial services companies that are underperforming. I think consolidation in our sector is going to be absolutely right. And I actually think other acquisitions for niche asset classes will actually become available to us. So, I'm not trying to deflect your question, but I think my vision will become a little bit clearer as those opportunities arise. If you look at someone like Close Brothers, they've had an excellent history of picking up small niche businesses along the way and actually making them perform well. And I think we can do the same with those two new asset classes.
And could I follow that up? Because you led into...
Most definitely. To get to $1 billion, we don't hide that fact. We're a capital-intensive business. And we're always going to need capital till we get to a point where retained earnings of the business are generating enough capital to generate the growth within the business. Yes, I hear what you say. We chose to raise our capital ahead of the 31 March deadline, which we thought might be a deadline, but it didn't end up being a deadline. It was difficult, and a lot of institutions said, we fully support why you might want to do that, but we're not actually in the mood to actually be investing in people at the moment, and I can understand that. As it's turned out, the terms weren't anything that I was proud about, but am I happy I got that money? As it's turned out and the way this year's sort of dawdled along, I actually am happy I've got that money, and it means this year has been uninterrupted by the fact that we've had to go out on a roadshow at a difficult time or have a failed fundraising. So yes, the terms weren't ideal, but look what we've done with the money. We've taken, at the point we raised that 10.75, our ROE was 10.3%, and we've taken it on to 12.5% in the year. So we're putting that money to good use, but I just wish it had been at a slightly better discount.
Yeah, it's not a criticism. I think you've done very well.
So yes, we will, but I would say yes, we will be coming back to shareholders to get to £1 billion, but we will put that capital to very good use.
And another question at the back here, please. Yes, please.
Hello. Yes, I wonder if you could just say something about your Bermuda-based majority shareholder. Mm-hmm. Who are they exactly, and how much day-to-day control do they exercise?
Day-to-day control, very little. We're very autonomous. They do have representation on the board. They're a specialist financial services investment company. They're listed in Bermuda. Their interests are mainly in the UK, but their largest investment is an Australian company called Resimac, which has about £9 billion worth of assets under management. It's a mortgage packager. It's it's a vehicle that actually bundles them up and securitises mortgages. Very successful business. In the UK, names that you might know are Waverton, the asset management company that they bought, used to be J.O. Hambro, and they also own Bermuda Commercial Bank in Bermuda, and they also own MJ Hudson, which is just about to float, actually. We're the second largest investment, long-term holder, like financial services, very pleased with their investment in us. They do have a large shareholding, yes, but they did a lot of heavy lifting back in the global financial crisis to get that by putting in a convertible, and that's how they got that position.
Lovely. Scott, thank you very much indeed. We're out of time there. Thank you. Are you going to be around for a drink later?
Yes, I should be.
Okay, well, if you have more...